My first guest noted that the love-hate has just noted that the love-hate relationship in this market with technology it's been somewhat bewildering, but he's still bullish. He says the bull market remains intact. I want to bring in Truist Advisory Services, their CIO, also Chief Market Strategist, Keith Lerner. You know, Keith, you say that what we're kind of going through right now, this is sort of normal. Walk us through this.
Sure, Charles, and great to be with you. Yes, I mean, back in June, we flagged in our work that on a short-term basis, the road band for tech just got too extended, but the chart you're looking at, Charles, goes back to the start of this bull market. We call it the Chat GPT bull market. Right there, over that time frame, the market's up about 220% for the tech sector. But during that time period, we've had 5 corrections, double digits. All of them feel uncomfortable. All of them come with bad news. We still think the bull market trend is intact, but we think it was overdue for a rest, and that rest likely has further cooling.
You know, it's amazing that you point that out, because when we're going through it, it does feel like, you know, maybe we're spoiled or whatever you want to call it. 3 months, 1 month, 4 months, 5 months. We're 2 months into this. The duration has been short enough, I think, for people not to freak out. Would there be a point, if this continues to linger longer, because this year we've got the midterm elections, that maybe this time could be different?
Yeah, I think we always have to keep an open mind that this time could be different. But so far, when we look at the weight of the evidence in our work, one is that we just think, again, the rubber band got stretched. Remember, tech was up 47% off the lows. It was the only sector to outperform. That's really unusual off the lows. Semiconductors last quarter were up more than 80%. That's a record. So you come into this quarter with high expectations, and this so far, we can't beat those high expectations. So we just think there's a cooling period. But the main thing we're focused on, Charles, to answer your question, is earnings. Earnings are still making new highs, and relative valuations for tech is now at the low end of the range with a very small premium to the market. So I think that's at least encouraging that we're at a more mature phase of this cycle.
So earnings have been phenomenal, and they've been greeted with the Bronx chair. Does that worry you a little bit? You know, it's like, oh, man, you know, in baseball, someone hits it over the fence, it's a home run or a grand slam. You hit it over the fence now, you strike out.
Yeah, well, you know, we always talk about this, the market's not being about good or bad news. It's all about how news comes in relative to expectations. And when you have good news like last week and markets don't respond, that is, at least some indication that this kind of corrective period has further to go. You just pointed out those credits spreads, or the interest that these companies are paying on their debt is rising. So that's something as far as the risk side that we're watching closely. But all in all, a lot of these companies are actually pretty low on the leverage side. They're just adding leverage for the first time, and people want to see, you know, that all that capital spending turn into profits as well.
I know, but see, here's the thing that boggles my mind, right? Because you've got a lot of smart folks saying, hey, as soon as these hyperscalers stop spending, that's going to be the red flag that the rally's over. Well, they're not going to stop. And so far, they haven't been treated well. So they're between a rock and a hard place. And of course, the bond vigilantes are pushing back on raising money through that way. So now we'll get more of these companies raising cash. I mean, are you concerned maybe of some sort of dilution or something else that lingers long past the return on investment?
Yeah, I think that's the open question. And the discussion I was having with our tech analysts today is that, you know, the variability about the outcomes are so wide, Charles, that investors, because the path forward is so uncertain as far as how they turn all this spending into profits and the timeline, that what markets are doing, or investors, they're re-rating the stocks down for that uncertainty, which makes sense. I think you do have to give these companies the benefit of the doubt that they're juggernauts, their core businesses are relatively strong, and they will figure out a way. But because of this uncertainty, this volatility is going to persist.
Hey, let me talk about this table here you've got now. The good news is that money hasn't necessarily, dashed to the sidelines and jumped into a foxhole. We've seen some pretty good rotation. March to June 2nd, technology up 47%, since then down 9%. But, other areas are up since then. Financials have done well. Healthcare has done well. Utilities, energy, we can go on and on. Do you think this is temporary, or is this a new paradigm?
Yeah, so, I mean, the one thing you're pointing out is money isn't leaving the market. It's not liquidating. It's just moving. It's rotating into other areas. So I think this rotational period likely has further to go. I think later in the year, money ultimately will come back to tech. But in the meantime, we're keeping that long-term position in tech. We also are overweight financials, which is at a new high today. Healthcare at a new high today. industrial is doing better as well. So I just think there's more opportunity beyond tech, but don't give up on tech would also be our message, at least longer term.
Yeah, I got a minute to go. And again, we've got tech here. The forward earnings estimates are absolutely through the roof. The next 12 months PE ratio, they've gotten extraordinarily cheap. So I'm glad that you're providing the message. What about some of these exogenous things? The situation, for instance, in the Middle East and things that are popping up. All of a sudden, you get Kimi K3 out of left field, and that changes the sort of not necessarily the narrative, but certainly the debate.
Yeah, so something we've talked with you, Charles, is really as we head into the midterm elections with inflation uncertainty, interest rate uncertainty, we have been expecting a bumpier path as we go into the year, later into the year. But all in all, the earnings continue to be the North Star. We're not seeing any slowdown in the earnings. This earnings season is strong, even though the stocks aren't reacting yet. I think all in all, we just, investors prepare for that bumpier path, stick with the primary trend and look at pullbacks as opportunities. And again, as we always say, we'll continue to follow the weight of the evidence, keep an open mind. If something changes, Charles, we'll share that with you and your viewers.
All right. We appreciate it, Keith. You were the right person to start this week off with. Thanks, man. Appreciate it.
Thank you.